And we're live. Hey everyone, how's it going? I'm Kristen, the general manager of Hatch, and with me is Natalie, who's Hatch head of experience. And we're really looking forward to spending the next hour with you. Thank you so much for joining all over New Zealand. Would love to see where you're calling in from. Give us a wave. You can comment on the bottom of the video, the streaming video, comment, and we'll see your comments. Would love to say hi. And of course, as we go through tonight, would love for you to ask questions as we go. We're going to go slow, and as questions pop up, I will interrupt Natalie, who likes to speak a lot, and answer those questions for you. already.
I liked when you said we're going to go slow. I was like, we're not going to go slow.
No, we're not. We're really fast. So sorry. But anyway, it's going to be a great hour. So tonight, we want to chat about why 2021 is a great year for investing. We're going to take you through a bunch of stuff, but just some legal stuff initially. Oh, hey, Auckland. Hey, Nelson. Love it. Want to see some more stuff as well. If we could get Invercargill all the way up to Whangarei or even further north, that'd be, hey, Taranaki, that's awesome. Welcome. Great to see you all joining in. Sorry, back to legal stuff. When we talk about stuff, we get excited. We kind of talk about our investing philosophies or others, and it doesn't mean it's right for you. It's kind of general. We give really general kind of investing tips, but really it's supposed to trigger you to go do your own research. It's not personalized advice. Your situation might be different, and there are risks with investing. There's always a risk that you could lose money in the share markets, and so we want to talk about some of the mistakes which kind of increase those risks, which should help you out there. So Nat, before we begin, we have got a sponsor for tonight, which is really awesome, and it's Moa Wines. I hope you guys took advantage of Nadia's from Georgia, the country. Wow, that's cool. Whangarei. Hi from Lee. Hi from Kitty. Hi from Southland, Wellington. Oh, cool. Southland. Cool. Sorry, did I say that? Anyway, I hope you took advantage of Canadian Wellington. Hey! Me too. Of the Moa Wines gifts, the giveaway, but also the what is it called? We get money
Discount
off. Discount code.
We haven't started drinking.
And you're drinking wine or coffee or tea or water. Just really nice to be in a very casual setting talking about money. It's how we roll. But thanks to them, obviously Moi is a South Auckland winery, and we tonight are drinking. It's a boutique. It's beautiful, and we're drinking their beautiful rosé tonight. In fact, Nat, you might want to top me up because I would love a little top up.
It's all right. We're 2 minutes in. We need to top up already.
So why we like to do wine and wealth is because we think the finance industry is really stuffy, and typically it's people in suits and they're talking words that we don't understand, and we should just get together as friends, have a conversation over a glass, which is why we've chosen to partner with Ma, which is so cool. We've also partnered with Husky, who's got these amazing wine coolers, keeps wine cool for 6 hours, fits any bottle. And we'll be doing a giveaway for these Spiegel glasses, also the Husky wine cooler at the end. Actually, it's probably in a couple days' time, and our lovely marketing team who's behind the scenes will be in touch with the winner. So yeah, cheers to everybody. Super fantastic to be here. So we're going to kick off with what we're going to chat about tonight is why investing, because, there's lots of things to do with your money. Why invest it? Why invest in shares? We want to talk about share markets 101, like just get down to the basics, real simple stuff. We want to talk about investing mistakes. We'll try and stick to 3. And because I think those are the main 3, if you keep those in mind, investing is actually a lot easier than you think. And then how to build your first portfolio. I think we're going to chat a little bit about that. So we're going to crack into it. But Nat, I'd like to ask you why, share markets have done some crazy stuff over the last year. Why would we invest in them now?
I don't know if the share markets have just done crazy stuff over the last year or so,
okay.
But one of the reasons why it is a good idea to start now is exactly that we started to notice it. So basically it's a perfect storm at the moment, and it's a beautiful perfect storm. We've got ridiculously low interest rates. So if you've got your money sitting in your bank account, you're going backwards. And the reason for that is the price of stuff is increasing faster than the interest you're earning on your savings. So $100 at the beginning of this year is going to be worth $99 at the end of the year. So that's no longer a good option for people. High property prices coincidentally combined with that. So for more and more of us, property is less and less attainable. Huge barriers to entry with the amount of money you need to save while paying ridiculously high rents while you're saving. Suddenly that's become a much harder option for most of us to access. And then the third thing that I think we don't talk about enough, which kind of you alluded to, is suddenly we have affordable access to the share markets for the first time. And I think two or so years ago when we launched, it was about $100 a trade plus exchange fees to buy any shares in the US share market. So you needed a lot of money to invest. And that's part of the reason why Hatch was launched, to provide that access. But what that's meant is more and more people, despite the myths that Kiwis only like property, have actually started to see the share markets as a viable option. So more and more people are out there telling their friends about the success that they've had investing their money for the long term. I mean, at the moment, our oldest customers are about 2.5 years old, and a lot of them have seen 2.5 years worth of returns, up and down volatility, but they're starting to see the benefits of that kind of long-term thinking. And I think a fun fact on that is there's actually quite a lot of debate, but in New Zealand, we've always kind of assumed that property is one of the best investments, maybe because we have been cut off, but actually it's undetermined. But there are a lot of arguments to suggest that maybe the share markets are a better investment in terms of historic returns than property is. Property gets the hype for being stable. In New Zealand especially, we've got a weird property market.
But I think you can borrow against your house as well.
Yeah, absolutely.
That is
There's
the
some other
difference.
stuff there. There is some other stuff there. Higher barrier to entry, but less money on the table.
So you can borrow other people's money to do stuff. Yeah.
Whereas the share markets, you have to use your own money. Well, you should use your own money.
Yeah. And what's the average growth kind of share market year on year?
So we always talk about an average, and we always swing between 8 and 10%, which we actually need to lock down. Part of that is taking into account inflation. Part of that's taking into account timeframes. But basically, overall, since the start of the share markets, they've averaged in history about 10% return. That doesn't mean every year. The last couple of years, we've had, I think it was like 30%.
Well, we had 16. If anyone's kind of tracked what's happened in the last year, we had the COVID crash back in March, and share markets have gone incredibly well since the rebound. I think they kind of came back. They came right in August and then have continued to go up. So if you went to bed, if you'd invested $10,000 on December 31st of 2019 and woke up on January 1st, 2021. So you've kind of totally ignored, you'd put $1,000 in, you would have seen that money grow by $160 just by doing nothing with that doing absolutely nothing. So that's that 16% that grew. But the year before was over 30.
Yeah, I think it was. 2008,
another crash we had. That was about a drop of 20 something in the end. So lots of ups and downs,
I think
over time.
The important thing there is that these numbers are interesting, and and despite our best efforts, people like to follow them day by day, week by week, month by month. But when you've started investing over the long run, you start to realize that those numbers, they're interesting, but they don't actually mean a lot when it comes to your shares, because they go up some years, down some years. But over time, and I heard this recently that I thought was brilliant, if you look at any graph for a quality company and their share price, it's like this all over the show. But over time, you just see the same curve over and over again. And it's the same for the share market.
Yeah.
So it's interesting to look at the short term, but the real story is in the long term, as it is with property. And property has the same blips of up and down.
And I think we'll get into kind of what is the share markets. But the best thing I heard about why do they grow is that share markets is a collection of companies, and companies do better. And they're always striving to kind of sell more stuff and do better and grow. And those that don't kind of get kicked out of either like the funds, or they're not kind of the key investments that people are getting into. So almost is like you're investing in companies that are striving to become kind of more efficient, produce cooler stuff, have us buy more stuff, and that's kind of, anyway, we'll get into that. But I just thought, that's
Who's
why.
the one who talks too much?
But that's why they grow. Like that is why the share markets continue to grow, because it's all these amazing companies that are striving to grow,
absolutely.
and do better business, which is quite cool. which kind of leads us into the section of share markets 101. Let's just get some basic stuff out of the way, which, what is the share markets? It's really a collection of companies. Hatch is, I see your questions, by the way, and I'm not ignoring them. I'll bring them in when it's like smooth and it's kind of, it works. So I see your questions, not ignoring you. But yeah, a collection of companies are listed on the markets, and we can buy shares in those companies. Nat's going to talk about what shares are in a minute. But Hatch has decided to offer access to the US share markets, which is really any company that's listed in the US. So listed meaning they're on the share markets, that we can buy a slice of their shares in the US. And so I think we've got access to over 4,000 US listed companies. It doesn't mean they're US companies. We have lots of foreign companies that happen, Alibaba and a number of others that tend to be, they headquarter in the US, and they want to sell some of their shares on the US share markets because it is the biggest share markets in the world. It's where 85% of all global investing happens, is in those share markets. Why? Hugely safe place, millions and millions of investors. And what that means is property. If I want to go and get money, I have to sell the property. It takes a long time. It's like this crazy thing. If I need to get money and sell my shares, there's millions of people buying my shares, which means I can get my money back pretty easily because it's such an enormous market. It's safe in the terms that it's highly regulated. So while investing has got risks, that share market itself has got huge oversight, particularly since the 2008 crash. And so these companies have to disclose, share tons of information about their businesses. We can learn about them. We can learn about what we're investing in super, super easily. So we wanted to start there because it's like super cool brands that we know and love and use every day, from the likes of Netflix, Tesla, Apple. We happen to be on a Microsoft computer, probably are wearing Nike or Lululemon. And so that's why we thought we would start with the US share markets for all those reasons above. And it really is just a bunch of companies where we can buy their shares on a market, on an exchange, otherwise known as a stock exchange. What's a share?
So I was just going to add one last thing to that the share markets, and this is something we've talked about a lot recently, are a mechanism. So the actual thing you're buying is shares in a quality, hopefully, company. So it's actually a substantial entity. It's got offices, it's got people, it's creating products, it's got all the stuff about where you work. These companies have the same thing. It's a substantial thing. And the share markets basically just provide the ability to buy and sell shares in those companies. That's all they do. You don't give money to the share markets. You are buying shares from another person, much in the same way as Trade Me would work. If Kristen wanted to sell me her shoes, I would go through Trade Me, which is basically the product equivalent of a share market, pay Kristen the money and take her shoes. So that's basically what the share market's role in buying shares is. So what did you ask me? Sorry.
Well, I would want to know. So if we think about shares then, and I want to go ahead and be a shareholder in a company, so how would I approach it? Like, is it better to buy expensive shares or cheap shares?
Great question.
So Amazon is like $3,000. Thanks to fractional investing, I can just invest a few $100 in it. But like, should I buy an expensive share or like NZX shares, which are on the New Zealand share markets here? They're only around $30. So like, what does that all mean?
That is a great question, and it's one we get a lot. And I think even I had a conversation out on Investors Club the other day, and someone said, I've only just figured it out this year after investing for years. And so basically, here's how shares work. When you start a company, and this is everything from your local dairy to Amazon, you break the company into slices of ownership. So same as like owning a part share in a racehorse or a part share in a car or a part share in a house. The company split up to as many or as little shares as they want to break it up into. Then companies, what they call IPO, initial public offering, and list on a share market. So suddenly, rather than as a small company, I can say, I've got 100% of the shares. Kristen, would you like to buy some? Suddenly anyone could buy them. And that's a decision the company makes to raise money and provide more access. So what that means, though, is that not all companies have the same number of shares. So it's actually absolutely irrelevant how much a share is worth. And that's a really important thing to understand. Buying a $3,000 Amazon share and comparing that to a company that has a $20 share, No comparison. Do not do that comparison. There is absolutely no way to measure the value. And the reason for that is that each company is broken down into a different number of shares. So I think I did some analysis recently on Netflix versus Apple, I believe. And Apple has about, I think, 16, I'm going to get this wrong, so ignore the numbers, but let's say hypothetically 16 million shares. And Netflix has 2 million shares. So while an Apple share is actually cheaper to buy than a Netflix share, because the number of shares times the share price equals the company valuation. So let's say 16 million times 100. Let's say the share price is 100. That makes it $16 billion company. Maths is terrible. And Netflix is 1 million shares times $100. So it's actually only 100.
I'm not helping you out here.
So it's actually quite a different price. So what you're actually looking for when you're deciding what's cheap and what's expensive is the total value of the company. And the reason for that is if you look at it like you'd look at shoes or like you'd look at a TV, the number of shares, the little slices of ownership times the share price equals the actual price of buying the entire company, as it would if you sliced up your house into different shareholdings. So if I look at Apple and go, the total combined value of all those shares is, I think, currently sitting at $2 trillion, I need to look at that and go, is Apple worth $2 trillion? And there's multiple ways, and we can get into that at various stages to decide whether or not it is worth that much. But that is the number that you're looking at rather than the actual share price. So the great thing about things like fractional shares means you can totally ignore the share price because you can invest the amount you want to invest in shares and get the amount you want in a company that's a quality company that you believe in without worrying at all about the share price.
Cool. I hope that was clear to all. That it is. So really, I'm actually not, well, I'm going to throw some questions out, but I'm not really going to worry about the share price. All I'm going to worry about is who do I want to be a shareholder in? Either it's going to be a basket of companies, we'll get to that, or it's going to be a company. I'm not going to worry about the price so much because that's just a slice of a larger pie. Yeah. If it's more expensive.
And so what you might do is look at Apple at $2 trillion for the entire company. Let's say you wanted to buy the entire company, you'd have to pay $2 trillion. And then tomorrow the share price drops a bit. And so it's only worth $1.5 trillion. So I'd look at that and go, as a whole product, Apple's worth a little bit less now. Is that a better deal than it was yesterday when the share price was a bit higher? But I can never compare it to Netflix because it's a totally different number of shares out there.
And when you said buy the whole thing, actually Warren Buffett, who is probably one of the most, was one of the most famous, best investors in the world. He's probably nearing 90 now, isn't he?
I'm getting thrown some shade for the wine affecting my maths. No, I'm just terrible at maths.
Oh gosh.
Which is another myth about shares. Terrible at maths, quite good at investing.
I love it. I love it. So look, basically, Warren Buffett, back to what he said, was when you're investing in a company, we'll talk about funds in a minute, but when you're investing in a company, think of it as would you buy the whole company? Like, do you actually back that business? And so approach investing in shares that way.
Yeah, absolutely.
So you can learn a lot about a business with, online. We can learn about the CEO and the plans that they have. We can learn about how they're going. They have to get these quarterly, every 3 months, they have to put out a report card about their business. How their sales are going, what their plans are.
You can watch Starlink satellites going across the sky.
Yes. Starlink, if you're into kind of the future of space, and actually, well, we can get into space, but then we'll get on Kathy Wood and her new fund, but we'll have to be careful there. Look, take investing as, do I want to be a shareholder in this business? Would I buy this whole business? Do I believe in it? Do I think it's growing? But we'll get to more of that later. Just some quick questions. Someone kind of commented they wanted to buy some shares on Hatch that weren't available. Correct. So we currently, the philosophy of the broker that we use and Hatch is kind of quality over quantity. We don't do penny stocks. What that means is that they have to have, Nat talked about kind of their number of like Apple worth 2 trillion. A business on Hatch has to be worth kind of half a billion, 500 million on Hatch when we get it, which means that, we're talking a really solid solid
Which
business.
probably means most New Zealand companies on the NZX would not make it.
They wouldn't make it on the US share markets. Well, we will look at New Zealand share markets. Hold tight on that. But yeah, in the US share markets, you've got to, for it to get on Hatch, we've got prices over $1, but also kind of market cap over $500 million.
And market cap is that total valuation.
Yeah.
That is the share price times the number of shares.
So sorry if you can't find a share on Hatch, but look, request it, because we're always open to going to our broker in the US and saying, can you list this? It's obviously a high growth company. It's going to be kind of past this threshold in time. So we'll go there. And then I just want to ask, difference between Hatch and Sharesies. That was a question here.
I would say the difference between Hatch and any platform is and we've always said this since day one, Hatch was founded by a group of people who are keen investors who wanted to provide access and a way for New Zealanders to grow wealth. So we are very pedantic about different platforms and how we built Hatch. So when you're looking at what to invest in, great, know what you're investing in, but also know who you're investing through and what the pros and cons of that platform might be. So one of the things that Hatch decided very early on is that we wanted our investors to control their investments. So that means when you sign up for a Hatch account, you actually get your own individual US brokerage account, which means you don't see it, you don't have to bother with the FAF, you don't have all that ugly finance stuff, but that means you own your shares directly, which means if you own a full share or more, you get the voting rights that come with that share. So when Tesla has an annual general meeting, or Apple, or whatever company that you own shares in, you get the right to vote on the future of that company, which we think is very important. The second part about it is transferability. We never want anyone to leave, and we will cry, but we will never lock you into Hatch. So when you're with Hatch, you can move your shares in and out, and we actually have a lot of people moving their shares in from different other providers that are potentially far more expensive than us. And it's free to do, it's free to do from our side, and we help you move them across. Same goes if you ever want to move your shares out. They're your shares, you own them, you should have that right, even though it would make us very sad. So that's one thing. The structure of how you own your shares is quite different. I would say the other thing that makes us quite different is our pricing. And one of the things that we've both taken quite a different, and actually different companies take different pricing options. One of the other options these days is zero commissions, which means you get free buying and selling.
Hang on, nothing's for free.
Yes, we decided against that because you actually are paying. And what's the cool line about technology? If you're not paying, you're the product. So that means quite often your data is being sold to other people, which may put you in finance in a disadvantage when it comes to buying your shares. The other option is a percentage fee. And a lot of people focus on buying when they see a percentage fee. So they look and go, I've only got small amounts of money, so I want to just pay a small percentage fee rather than that $3 figure, which can feel like quite a lot when you're putting $100 in. Our philosophy has always been invest for the long term. So what that means is over time, with that 10% returns average, when you've put $1,000 in and you keep building it, that $1,000 over the next 5, 10, 20 years should grow to a much bigger amount. And what that means is when you come to selling it and you are stuck paying that percentage fee, who's taking a cut of your profits? Not us, because you're still paying that $3 to sell your shares. So for us, again, it's that long-term view, and it's that idea of we want our investors to grow their money and for us to not benefit or take a cut of the profits that your money earned for you. So I think those are the two big philosophies, and it's not necessarily about Hatch versus any platform. Those are just the two things that we decided early on were very important for the investors we wanted to have on Hatch.
Yeah, and we've got a vision that everyone has $1 million on Hatch.
In 20 years, and we're on track. Average investor at the moment is on track. The average investor on Hatch.
Yeah, 20 years, we want everyone to have $1 million on Hatch. So we'll keep giving access to really cool products, really cool investments over the coming years. And
lowering our pricing. We've lowered our pricing 3 times in 2 years.
Yeah.
And
we can do that because of scale. As we grow, we can kind of share, we pass on the savings, which is super cool. Cool. So I think we've done that. How do I make money with shares? I'm just going to quickly answer that one. But first I want to chat about, is Smart Shares safe? And New Zealand share stock exchange safe? Yes, it is. So I didn't mean to say, US share market's the safest, most liquid in the world. Actually, those investments here in New Zealand, you can sleep at night. Smart Shares is basically what they've done is it's a New Zealand owned company. And they've taken funds from either Europe or America, and they've kind of wrapped them and listed them again on the New Zealand share markets. And so what it means is it's the underlying fund is probably the same thing you can get through Hatch, but it's probably quite a bit more expensive here. However, there's some differences. Like they pay your taxes for you on Hatch. We kind of make that really simple for you, but
you
like
have to potentially do something.
Yeah, you kind of have to do it. So while you can probably get the same underlying fund on Hatch for quite a bit cheaper, that's why a lot of people come to us, is because you can go straight to the source of where the fund is before it gets kind of wrapped and relisted, which is huge, enormously expensive here in New Zealand. They get it for far cheaper. But then at the end of the year, we kind of have to send you a tax report, and you do have to report those earnings for anything sometimes over $200. But that's like a whole tax thing. So hopefully.
But I also just wanted to comment on the safe thing, because it's very important we get this clear. The safe word comes from the mechanisms, the markets themselves are very regulated. When it comes to investing, the risk you're taking on, especially when you're choosing your own shares, is the decision you make about what company you invest in or which fund you invest in, and then the decisions you make once you've invested in that. So nothing is safe beyond the decisions you make. And by that, I mean, if you panic, if you make some of these mistakes we'll talk about soon, all we mean by safe there is that the mechanisms of buying and selling are pretty...
Do you want some more?
Gosh.
Sorry.
The wine is already ruining my mouth.
This is sold out wine. We've got exclusive wine here. You didn't have the wine when you did the maths. Anyway, I digress. Very good. Gosh, so many.
I think we're talking Aussie
IPOs.
shares,
Okay. Aussie shares, ASX, Hatch. We're going to launch ASX, which is Australian stock market, as well as the New Zealand in the coming year. Yes. We're growing the team. Are we hiring? Reach out. hello@hatchinvest.nz. We are growing and growing quickly. Can we get IPOs? IPO, we just before we move on to investing mistakes, IPO, initial public offering. When a company needs money, and they're private companies, so it's likely they've grown by probably like venture capital. Like let's think about Bumble. Bumble is a private company right now.
Perfect timing for Valentine's Day.
Yes, Valentine's Day. For those that use Tinder, Bumble launched years ago. It was a co-founder.
Great saga. Look up Whitney. What's her name? Whitney.
She left Tinder. Anyway, she left Tinder because she didn't want to, didn't like the whole, male thing on Tinder. Who knows? Started Bumble. So they're a private company. So what she's done is gone to a bunch of private investors and kind of they've invested in Bumble. Now she wants to go big time. Like they're at a position now where they actually want to list on the stock exchange. And the reason they want to do that is because they want to raise a lot of money. And they're also happy to give up shares to do that. So they're probably going to sell, however, 34 million shares this Friday morning on Hatch. And that's called an initial public offering. And what that means is Bumble will shares will list, and you can buy a slice of Bumble. And they're looking to raise about $2 billion. They'll then take that money to grow the business. They'll do all sorts of cool stuff.
Marketing.
Yep, they'll improve their app. They'll grow their company. They'll go into India. I don't know. I'm not sure what their plans are, but that's an example of a private company going public, which means that people like you and I can buy into it. But what happens with an IPO process is, which is going to change in the future, by the way, is that these big investors kind of get the first cut of Bumble. So what happens is we get it the next day. So retail investors, which we are, everyday investors, kind of get Bumble once it's listed on the public share markets, the US share markets. Hatch will be listing it, but it sort of roll on at some point Friday morning between the time of, 4 a.m. and 10 a.m.
It depends on how much demand there is and how it works.
Who knows? But yeah, so basically they're looking to raise a bunch of money. They're going to sell part of their company to you to do that. And unfortunately, we don't get kind of the premium pricing and the cheap pricing the night before that.
At this point, it would just be the logistics of the market. Yeah, the share market.
That's reserved for the elite. But there's a revolution happening, thankfully. And so soon we hear a lot of companies going direct, which means they cut out these kind of big fish, go straight to you and list. And so Slack was a good example of that.
Long night.
Was Airbnb direct?
Can't remember.
I don't know. Anyway, so that's an IPO.
Say two more things about Bumble, just because I think it's interesting. Is it both about Bumble? One is if you're interested, if you're following along at home with your watch list open, and you think internet dating is a thing, like our studio audience over here, if you think internet dating is a thing, that is a trend or an industry that's quite interesting, we already have Match.com. Or Match Group, I think it is, on Hatch. And they own a ton of dating sites, from Tinder through to Plenty of Fish. There's a whole bunch. So if you're interested in researching this area, go wild. And the second thing I wanted to say, which was about IPOs, is that there's a misconception quite often that when you buy shares, you're buying them from the company. So if I was to invest in Bumble, I would be paying Bumble the money and taking the shares. That's not happen. That doesn't happen after a company has listed on the share market. People have already bought those shares. So when I'm buying shares, I'm buying them off another person.
We're buying it from each other.
The company
Not selling her shares, I'm buying it off her. So the company doesn't benefit anymore.
Apart from for some like maybe debt things, but complicated, boring. Google it.
Blah, blah. Brody, nice to see you. So it was lovely to chat to you on your podcast. Thanks for tuning in. So we're going to talk about GameStop later with investing mistakes, actually very shortly here. But we want to talk about men in suits and stereotypes of investing because, that's why we're here drinking wine, talking about money. Because there is a wealth gap with women, which all the women that have joined us. We've got, we know that we end up in retirement due to all sorts of reasons with less money than men. We take breaks in our careers biologically. There's still a pay gap in certain countries here in New Zealand. And when it comes to kind of, I guess there's a stigma that we're risk averse, and we're not going to go into this because we're risk aware. Like, women are awesome with money. Like, they're the ones that are budgeting, they're juggling the things, they get the outgoings, the incomings. But because it's almost like we just care so much about, we recognize the value of money. I think there's a stigma that the share markets, we're kind of losing it. And it's, and we hear about this, like, don't invest what you're willing to lose. Can't afford to lose. So chat about
I'm Christian from Love From Your Dags. I'm not sure if he's online now, but I heard him beautifully put it the other day. The rule is actually don't invest money you can't afford to be without for 5 or so years. And the reason for that is you never, ever want to be in a position with shares, which do fluctuate in value, that you need to sell them in a hurry. Because if things are not looking great for that company share price, not necessarily a company, and we've witnessed so many examples recently. What was one the other day that I was like, I'll write this down to talk about today, and I've completely forgotten. I think it was something, it might have been Tesla, which I bring up every time. Their earnings report for the quarter, which is basically how much money they made that quarter, came in lower than expected, which Tesla always does. Share price drops. Company's no different. Nothing's changed, but the share price drops. So all of that stuff kind of just has a little bit of an impact on that sort of thing. So you don't really want to be in a position that when Tesla's had a bad earnings report and their share price drops and you need money out to buy a car, that you have to sell your shares at that point. You want to give yourself that time. So, but that myth about don't invest money you can't afford to lose blows my mind. If you're in a Kiwi saver and you're in a balanced or growth fund, your money is largely invested in shares already. And I would suggest most of us can't be without our retirement savings in retirement. So Correct. It is money we can't afford to lose.
Yeah. So back to busting the kind of men in suits. Well, we've done it. I think there's been some awesome renegades that we could look to in the past. We've got Ellevest and Sally Krawcheck, who's this kick-ass Wall Street, incredible woman that's kind of paved the way for women in investing and kind of demystifying all the crap that's out there. And then we've got Kathy Wood, she's running one of, Nat's like got a fangirl crush on Kathy Wood.
I emailed her to get her on this webinar.
We will get her on. And we need to start a campaign to get her on kind of the next webinar. But she is a female. She's a renegade. She's running kind of one of the most successful fund companies in the world at the moment. And incredible funds, really innovative funds at the moment that are available on Hatch, called ARK Invest. She runs this incredible company.
I think you're about to launch a space one. And
so she invests in the future and she really backs the future. And so
well worth having a read.
Yeah, have a read.
Kathy Wood. And again, a brilliant story. If you think everything's boring finance, it's not. It's brilliant stories about women taking on Wall Street, backing what they believe, having the right smarts, doing things differently than the finance industry normally does. It's really interesting stuff.
Love it. So let's talk about diversity after, when we talk about how we build a portfolio. Diversity. Diversification, because we have a couple good ones there. In terms of ethical standards. Yeah, look, the great thing with Hatch is that you can back what you believe, and we'll talk about that with convictions. But if you're interested in companies that are operating to a certain standard, keep an eye on something that's called ESG, environment, social, and governance. And often there's ratings related to those. And so if companies or a fund is kind of rated as ESG, what that means is that that company is operating at a really high standard. So in terms of environment, they care about, they're not polluting the environment. They're doing social good. Governance means they have diversity in their leadership and on their board. And social is they're lending a hand to the community. They're giving back. Doing social good, not just bottom line. So there's this ESG kind of company ratings, but there's also funds that are ESG. So if you want to feel good about what you're investing in, and
there's plenty of evidence to suggest that ESG companies are much more sustainable in terms of profitable as well. There is some, again, read up on it.
Sustainable investing.
Some evidence to suggest it's a good financial investment.
Absolutely. Well. Just kind of Google ESG funds or ESG companies, and you can back kind of what you believe if that's what your values are.
And just to finish up on that, the reason we don't choose which companies we believe are the most ethical of all the investments is if you ask Kristen what her ethics are, and if you ask me, and if you ask our studio audience, Rachel, who's sitting here having a wine too, we all have slightly different ethics. It's not our job to tell you what your ethics should be. So we provide you the access and you decide the things you believe in. And it could be making the most money, and that's fair.
We're told to get back to our script. I love it. Thank you. Hatchlings in the background. Look, we want to talk about 3 mistakes. We're going to rip through these 3 mistakes because with investing, just avoid the real baddies and then don't worry about it. You don't we worry too much about how we do it right and are we doing things right and then we get ourselves all in a bind and don't do anything, such as life and human nature. But rather, let's just focus on 3 things what not to do. The first is trying to time the market. And this is really kind of this is if you are thinking, should I invest now? Or, I heard the market's going to drop in a couple of weeks' time. I'm going to wait until it drops. When we launched Hatch 2.5 years ago, we had some people come to us and say, we're not going to invest because we're just going to wait for the next crash. Well, that didn't happen until March this past year. And there were massive gains that those people lost out on that were sitting on the sidelines. So it's kind of just thinking.
Could you dig into that a bit more? Because I think you gloss over it, but that's a very meaningful thing for people to understand.
It's with investing, it's time in the market rather than timing the market. So there's never going to be a perfect time. You could invest tomorrow and you could wake up in 2 days and you could see your investment, your money going down. And that usually people call it red because when your money's down, it's red. And when you wake up and your money's green, you've kind of woo, I'm up, which is great. So it feels a little bit like gambling, which it's not. So don't check in too much to Hatch and kind of your investments. But basically what it means is yes, you might get some red, but we've talked about earlier, over the long term, the share markets tend to increase if we look back at time, 10% year on year. So if you're just patient, it takes time for these companies to grow and to get better and to kind of, get better and innovate, grow, sell more things, make new products. It takes time. So we kind of have to be patient. And it's a little bit it can be a bit boring at times. But if we were to nobody can time the market right. I remember chatting with a mate that said, take your money, all of your money out of the share markets in November because it's going to crash because we've got Trump and the US government and Biden coming in and blah, 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 blah. Well, the share markets have gone incredibly well since November. So had that person come out, again, timing the market of the share markets, they would have lost all those fabulous gains between November and now. So look, share markets go down, share markets go up. Don't try to time it. Just get in, get your money working for you.
And I think, I don't know if Hayley, now you've stopped yelling at us about getting back on script, have the opportunity to put up a link to our FAQ at the moment, but we will turn it into a more fully fledged article about compounding returns. And I think to your point about the green and red, one thing I've realized as a long-term investor, I've been investing for about 15 years now, is you see more and more green the longer you invest. And the reason for that is compounding returns. That person who said in November to take your money out, we might have had a 10% increase since then, something like that. Times that by 5 years, the ups and downs, that even if your share portfolio drops by 20% in a day, because you've had 10% returns and then 20% returns and then maybe a 4% dip, and that 20% return is on drop is on all those gains. So you're still up over the long run. And I think that compounding returns thing, please read Compounding Returns. It is the 8th wonder of the world, and it makes those green and red things a very different story the longer you stay in the market.
Love it. You have 60 seconds to talk about second mistake. So third mistake, time in the market. 60 seconds to think about the second mistake, which is?
This is what I've learned recently. There is no one right way to invest. And I know that sounds weird. And I think particularly timely when we're talking about GameStop, it can seem at times like there is one great investment. Like Kristen said before, there are 4,000 odd companies in exchange traded funds. We won't go into that just yet, on Hatch. Any one time, at least several thousand of them are a great investment. You know your niche, you know the things you're interested in. It might be space, it might be cannabis, it might be clean energy, it might be female leadership. There will be a ton of quality investments in that area. Even if you think the rest of the world, and I think GameStop was a prime example again, that we only had actually about 3% of hatchlings were investing in it. Everyone else is focused on their own approach, and they're doing their own plan, and they're investing in the things they're interested in that they know about. So don't get caught up in this idea that there's one good investment, because there are thousands of them. Every day I hear about someone else investing in something that I've never heard of, and that's made them decent amount of money, but it's their passion, and I just think it's brilliant.
Yeah, I love it. And we will talk about kind of a really common approach when you're signing up to Hatch, and how you might kind of build your first portfolio so it doesn't feel so overwhelming. But absolutely. So the number one mistake of investing, which you should avoid, which we are going to talk very quickly about GameStop, is FOMO and hype investing. And that really is about, you hear about something, and by the time you hear about the investment and it's hit the papers, it's probably too late. And that's like, oh God, everyone's investing in this. Should I invest in this? I saw a question about crypto earlier. Hey, like very quickly, crypto spiked because of Elon Musk has now bought, a bunch of it, and potentially going to accept Bitcoin in the future. That's kind of hype. But crypto, like, that's a whole other thing. When it becomes mainstream, like, cool, like I might invest in it.
The thing that we're saying about hype and FOMO is, there is no such thing in many ways as a good or bad investment. If you went in and you decided to buy shares in GameStop recently because you had a valid reason that you'd looked into and you understood what you were doing, all power to you.
Yeah.
If you read one news article and bought in because you thought everyone in the world was doing it, you are setting yourself up to fail, because you have no idea what you've bought yourself into. And I think that's the case with crypto. It's the case with any industry. If you are making a calculated choice, absolutely. And sometimes, because investing has risks, some emerging industries like Elon and his Starlink may not pan out, or a company through like cruise ships at the beginning of COVID have unexpected events that happen. So there are risks like that. But absolutely, if you know what you're investing in, you've reduced that risk of going in blind. And everyone I speak to who's had, I don't know if you've had this before, but 1986 crash, my family lost all their money. This crash, 2008. If you ask anyone who says that, if your response is, what did they invest in and why? Every single one of them will say, well, someone told them to invest in this and they just did it. And that's the problem, not the crash. A lot of people made money out of both of those situations.
And a good example of GameStop, if you don't know about it and you invested in it, that would be a perfect kind of FOMO hype thing. Because I think GameStop in itself, it's a video company. In fact, isn't there one in Wellington on Kiwis Street?
I think it's EB Games in Wellington, but I couldn't tell if that was a joke. Anyway. I saw that somewhere.
Okay, all right. Anyway, it's a video company that didn't kind of really innovate. So again, this is a business listed on the share markets. And what happened? It's in malls, and you can buy video game like
physical games,
DVD. Yeah, basically.
We're gamers, clearly.
I digress. Anyway, so what's happened was COVID lockdown, pandemic, and a lot of businesses that weren't online were hurt. GameStop was one of them. So what happened was a bunch of these like big institutional Wall Street hedge funds, they're called, and they basically bet. One of their strategies is bet against businesses, and they benefit from failing businesses and falling share prices. And so they were like, GameStop, you're screwed. We're going to bet against you. And they bet billions of dollars against GameStop. Now, everyone in Reddit was like, wow, if we pile into this GameStop stock and buy into this share, which keep in mind, this is a business that's not going so well, potentially could fail, we're going to kind of stick it to them, and they're going to lose money because when the share price goes up, they lose money. When the share price goes down, they make money. So in effect, they kind of lost a lot of money, but it's a really good example of hype investing that a lot of people kind of got into GameStop when it hit the media. You know, that's kind of a risky strategy. That's a perfect example of hype. They kind of got in not knowing why they were getting in, where those initial investors were like, we're really going to do this thing against kind of against Wall Street. And we kind of got this like David and Goliath thing going. Anyway, so yeah, there's a post there about what's going on.
That is the same in any industry. You'll see when Tesla gets in the news, there's a spike in people investing in it. When you see any of these companies, so I think the rule that and if you join our investors club, you'll see that there is a whole range of experiences in there, but there are a bunch of people who've been investing for a long time. They've seen a lot of the hype. They mostly have been burnt by it at some point. And you tend to not make that mistake twice. And you start to really back yourself and invest in things that you know, because you sleep at night when you know what you've invested in. A lot easier.
I just want to cover two quick questions before we get on to how we will build a portfolio and diversify our money on a platform like Hatch. And the first is, would we invest in a fund instead of a savings account? When you're investing in an exchange traded fund or ETF, sorry, we will talk about that in a minute.
We'll do the link on there too, hopefully.
Yeah, there's going to be a link that comes up about what is an ETF. That's a magic link. It's a basket of companies, basically. You're spreading your money across hundreds of companies instead of one, which is fantastic when you're starting out. But it's like people are kind of saying, look, my savings account is going backwards because of inflation, what we talked about before. Should I actually just put my money in a fund and spread it across hundreds of companies? And is it better? And I actually would say, if you've got your emergency fund, and that's kind of part of this investing thing, get yourself in a position where you've got a couple months of money just sitting there doing nothing. I'm sorry, but that's just the way it is. Because what happens if the share markets crash and all of a sudden COVID pandemic hits and you lose your job and you need to get some money out? Now your money is kind of in the red. You've lost a little bit. Not great in the share market. So sadly, I wouldn't.
The rules don't change.
The rules don't change.
If you need your money in a hurry, put it somewhere that you know exactly how much it's going
and
to
it's
worth.
Sad because it's kind of doing nothing there, but it's kind of for those emergency times. It's why it's called an emergency fund.
But if it's a long-term savings that you don't have any plans to need in a hurry, then you can make different choices, but it's not the same thing as a savings account.
And in terms of, someone else asked, so basically if I'm selling shares, so say I'm an owner of Apple and I need to sell a share, I kind of have to wait for buyers in order to sell my share. So I could kind of be stuck with the share. And that's absolutely the case. But with the U.S. share markets,
and like the size of the company,
and the kind of quality of the shares on Hatch, there are millions of buyers waiting to buy your Apple shares. So it is instantaneous.
And that is something you can actually see. I think if you look at Yahoo Finance or other things, it's called volume.
Yeah.
And that's the number of shares that have been bought and sold that day.
Massive.
So quite often, if you compare that to the NZX, the volume is just on an astronomical scale different.
Massive. So let's talk about how we might build a portfolio. So I'm like, I got it. I'm going to invest. What am I going to do here? We want to talk about approach, which we've called core and convictions.
It's not sold on the name yet, but it's getting better.
No, it's fine.
Better than Sexy Island, which is where we started.
We did. Boring Island and Sexy Island. Anyway.
Mainland and Sexy Island.
Anyway, core and convictions. And it's a really simple approach. It's a common approach. Again, this isn't advice. This is a very common approach that people take. And what they do is they build, let's say that you're investing 10% of your paycheck. What people will do is they'll take 80% of that money and they'll invest it in core. And what core means is it's kind of boring. It's set and forget. We talked a little bit about what an exchange traded fund, what a fund is, and you don't kind of have to put all your money onto one company and really hope that they do well. You're kind of spreading that 80% of that money across hundreds of companies. A couple there are thousands. A couple really popular funds on Hatch are like a Vanguard
S&P
500, which an S&P 500, which means you're spreading your money across the 500 biggest companies in the world on the U.S. share markets.
And the reason, just so you know, that one, just so you know, so they know, that one's quite popular, is those 500 companies are global companies. So it is the Apples and Amazons and these giant companies. And the reason people like that fund so much is it's kind of considered a reflection of the overall share market. So when we talk about 10% average returns, that's actually generally based off the S&P 500. And the reason those 500 companies are so representative is because they are so big that generally about half their revenue comes from America, but the other half comes from overseas. So it kind of gives you an overarching view on how good the world economy is doing at any one time.
It's spread. So very cool. So we've got kind of our money spread. There's another one that's called total share market, and you can Google this, just be like, what's the best total share market ETF? And that's spreading your money over about 3,000 companies around the world. And you're basically invested in the share markets around the world. So if something,
Europe,
basically. So there's kind of a couple really popular funds on Hatch, and Vanguard is a well-known fund manager. There's a Vanguard S&P 500. There's a Vanguard Total Share Markets, but there's also iShares, which do
BlackRock.
But
BlackRock's another interesting.
It's super simple to Google. Just Google like the most popular exchange traded funds in the world.
Best fund for a highly diversified investment. Google's your friend. It gives you a really good starting point for a lot of these things. It's really not as complicated as you'd think it would be.
So the core approach is kind of saying, look, a lot of my money is spread off around hundreds of companies. Keep in mind that the S&P 500, the biggest companies in the world right now, happen to be tech companies. So keep that in mind when we talk about conviction, because you know that a lot of your money in the S&P 500, some of the biggest companies in the world happen to be tech right now. Let's talk about Apple, Amazon, Tesla. They're not tech. Sorry. But yeah, they did. They're in that one now. But like, Netflix, like all the tech products that you use, your money's going to be spread across that when you're investing in kind of an S&P 500 fund. So let's talk about convictions. 20%, which some people apply to this core convictions approach.
Could be 10%, could be 5%, could be 0%.
Or it could be 40%.
But we think this is the bit that keeps life interesting.
Yeah. And this is kind of where you're like, this is where I'm going to back what I believe and what I know. And so for me personally, I would probably look at emerging kind of, if I think cannabis, for example, is going to go really well over the next 10 years, or healthcare.
Or going back to dating apps, I think that's an interesting.
Bumble. If I want to invest.
Healthcare, where that's going, there's so many, It
might be that 20% is my convictions investing. And that's in companies that I really, truly back, I believe in, I know a little bit about, and I recognize that they're going to grow over time. And so that's kind of my convictions. What are your convictions?
Elon. Yeah. No, I invested a couple of years ago in Match. I thought that was I just feel like everyone I know who's single is on a dating app, and they own most of the dating apps, and I couldn't see that going back to the good old days where you meet people in a bar, like classy people. So I think the dating industry is fascinating. What else? I think space. I just think like seeing those success. Kristen and I accidentally camped next to each other in the weekend, and we, not side by side, but together watched 60 Starlink satellites. And I just said, this is the last day of space innocence. Like we are going to space as a world, and fascinating stuff. I think electric vehicles. I'm a bit of an environmentalist, as I think most New Zealanders are.
Actually, that is a big one. There's a fun, and you don't have to invest in a company with conviction.
No.
It can be a conviction fund that's really specific. There's one called iClean, I think, and it's basically a green, clean energy fund.
And there's so many coming out. I think there's just so many. Millennials is another one. The power of millennials. There's a fund that you can invest in, or companies. The other thing that I think is quite interesting about convictions is, while we talk about risks and balance and diversification, we always talk about having a plan for what you want to invest in and why. And there are the odd risks that I've taken. I, during lockdown, saw the cruise ship industry and the airline industry be decimated. But I truly believe as COVID we get vaccines and that sort of stuff, I think people will travel again. So I invested in an ETF that backs it spreads my money across a whole bunch of airlines, because I don't know which ones will succeed and which ones will fail, but I feel like we'll go back to that. And I also invested in a cruise line because I think they are huge. I know that those are towards the gambling risk end. So I kept that a very, very small percentage of my money. But to me, it was something that I believed in, and I had a lot of conversations about it, and talked to a lot of people who cruise. So you can do that all the way back to sort of an industry like e-commerce that is a lot, which I've also invested in a few of them. Entertainment is like the Netflixes and the Spotifys. What do I do when I'm at home? So, I have a range of interests.
Yeah. So convictions is kind of like, just think about the world around you, what you're using, where the world's going. And look, if investing is stressful for you and you don't want to make it a hobby, convictions, you can just drop it and you can actually just have your whole portfolio in core.
But you can also, the other thing, if investing is stressful for you, there are other measures like having a plan.
Yes.
And when you buy something, knowing you're buying it for that long, and also using your community. And we have a community that is your community, and they are your best friends in a time of crisis, and they will talk you down from a ledge. They will tell you the sort of common sense, they'll tell you their lessons, and that is a much better approach than avoiding doing something or panic selling in the middle of the night. On Facebook, that you get invited to when you've made your first deposit into Hatch. The other thing is, if you're up in the middle of the night, we have learnt recently, my sister taught me this when she was up feeding her child in the middle of the night, not a good time to make decisions. She actually does post in our community in the middle of the night, and she said, someone liked a thing I wrote. I don't remember even writing it. She must be on Hatch while she's up half sleep deprived in the middle of the night. Don't do that.
Very good. We have a question about tax. Hatch makes it really easy for you at tax time. Basically, if you are earning money from dividends, which is a way you can make money from shares, there's two ways. One is that the share price goes up. Say I invest in Apple. Let's just say that the share price is, I don't know, $600, and I put $200 into Apple. So I own a slice of that Apple share. That Apple price might double over the next 10 years. So Apple might be worth $1,200 in 10 years, which means that my money has kind of doubled, which is great. So I make money because that share price has gone up. And so when I sell it, I make money. Another way I make money is companies pay dividends. So they make profits, which means that they're going really well and they love to share the money that they're earning from their sales with all of their investors, which is called dividends. And so with tax, you do have to pay tax on those dividends. It's earnings, just like if you're kind of hustling on the side, doing any side jobs, you do need to report that to IRD if your dividends are over $200. So we make it really easy at tax time. With those dividends, we kind of say, look, you made $100 on Hatch and dividends over the past year. And so if it's under 200, you don't have to worry about it. If it's over 200 of all of your investments. Anyway, we make it super easy. There's lots of tax stuff.
We'll do a link on tax stuff because we've got
lots of tax stuff.
Left,
so we're just going to talk about next steps. And I just want to do a plug for the Hatch Getting Started course. If 2021 is your year to start investing, we have a 10-day course. It's free. It's a kind of an action every day, takes you through a lot of the stuff we talked about at a very high level, but deeper. 10 minutes a day. Just Google. Actually, we're going to put it up. Hatch Getting Started course. That's your next step. Do it. If you've signed up to Hatch, start a watch list with some of the stuff that you care about, like the core funds we talked about, the convictions that you have. Start a watch list, and when you're ready, dip your toes in. But what else do you want to talk about? Actions.
Some other people either have done that and they're ready, or they are more doers rather than learners. And so we talk a lot about taking $100 and treating it as education money and making your first investment. The reasons for that are huge. One of them is people have a big fear of losing money in the share markets. We don't have a big fear of spending money on education. So if you treat it like education, you'll take that pressure off your own shoulders about making the wrong decision. Doesn't matter. It's $100 towards your education. There's enough skin in the game that you're not going to, one of the things about this belief that investing is gambling and people using small amounts of money is you don't feel that same feeling about the ownership of your important money, and $100 is getting towards that kind of, oh, I don't really want to lose it. So you do think, it forces you to stop and think. But also we'd really encourage you to think, because we've spoken to a lot of Hatch customers are very ambitious, whether they acknowledge it or not, that feels too small. Don't think that starting with $100 limits you to small time. You can change your life with $100. And the reason for that is a lot of people wait until they have a lot of money. I guarantee if you're nervous about investing $100 now, you will never invest $10,000 when you have that spare, because that is a much bigger amount to learn from. So don't think about it as a giant leap. Think about it as a small step. Treat it as education money. Learn your mistakes. You will make them. I haven't spoken to a good investor yet who hasn't made one mistake or hasn't made at least one a year. Mistakes happen all the time. Bad decisions happen all the time. It is not about being perfect. It's about limiting those mistakes and making more good decisions than bad ones. That's all you have to do to be successful.
Yeah, good. So worry less about kind of how to do things right and just do something today.
And let us know. If you take your first $100 after this and buy your first shares, please email us, hello@hatchinvest.nz. Our team thrives off this stuff. You have no idea how much we celebrate when someone tells us their story of their first time. We can also use it to help other investors get started, because we use basically everything our customers tell us to help lower the barriers for the next person who comes along. So please tell us your story.
And also Nat and I are always available. If you're on LinkedIn or whatever you're on, just reach out to us. We love to kind of check in with customer success.
We hate talking, obviously.
So always happy to chat with you, always, and learn together. So look, thank you so much for joining us. Super cool. Thank you to Moi Wines for sponsoring tonight with a fabulous rosé, which I've enjoyed. I've enjoyed, and Husky Wine Coolers. Thanks so much, and thank you for taking an hour of your time. Have a great night from the north of this beautiful country, safe country we live in, all the way down to the south. Happy
and everywhere
investing.
else that people make
Everywhere else, and happy 2021 investing all. And we'll catch you soon. Take care.
Bye.
Bye.
Cheers to my fly wine.